Welcome back to another portfolio update. In this update, I'll be buying 3 different stocks and 1 ETF for my RRSP. Let's dive right in. The first stock I want to talk about is Magna International. The best way to describe Magna is that it's a Canadian mobility technology company for automakers. Magna is currently investing heavily into AI and level 5 automation. It is one of the largest companies in Canada and was recognized on the 2020 Forbes Global 2000 list. Not only is it one of the largest companies in Canada, but it's also one of the largest auto parts maker in all of North America. It has consistently ranked in the Fortune Global 500 list for 20 years in a row. Investing in this company gives you exposure to a large part of the automotive supply chain. Magna is now leveraging its engineered and manufacturing know-how to help automakers and tech companies build electric vehicles and autonomous vehicles. Rumor also has it that it's a top contender to be working on the Apple car. Magna is now known for innovation. It focuses on autonomy. Autonomous vehicles won't just change mobility, they will change the world, and this is where we're headed. Electrification, the future is electrified, and Magna is right there. Lightweighting and smart mobility. Magna is the world's 3rd largest automotive supplier by sales. Track record of returning capital to shareholders, and it's in a very strong financial position. Looking at their Q3 2020 performance, sales were down 2% because of COVID-19. However, consolidated adjusted EBIT was up 39%, and the adjusted EBIT margin was up 250 basis points. And it has grown its free cash flow and has returned $115 million to its shareholders through dividends. Magna is now seeing a higher adjusted EBIT in all of its segments: body exteriors, power and vision, seating, and complete vehicles. Taking a look at its cash flow, it has a free cash flow of over $1.3 billion. And out of that $1.3 billion, $115 was returned to shareholders via dividends. Magna is also launching the ArcFox electric vehicle, which is the first electric vehicle produced with the ArcFox brand by the Magna BJEV joint venture. The next decade of growth for Magna will be coming from the e-mobility market, either through the hybrid program or the electrical vehicle program. And you can see that the plan is to grow the electrical vehicle market from 2% to 10 to 15% by 2030. Looking at the stock details for Magna, it's currently trading at $112 per share. It has a market cap of over $33 billion, a PE ratio of 44.58, and earnings per share at $2.52. It has a yield of just under 2%. Looking at the last 3 months, Magna is up almost 25%. Going out to a year, it's up 150%. And if I zoom in all the way, it's up over 370%, and it's been paying those consistent dividends. And it's also had a stock split in 2015. Looking at the statistics, it has a profit margin of 2.32 and an operating margin of just under 5%. The payout ratio is just over 63%, has revenue over $32 billion, and quarterly revenue growth of 12.5%. It has a very healthy EBITDA of over $3 billion and an operating cash flow of $3.28 billion. Its most recent dividend was 54.4 cents in March of 2021 and has consistently grown that dividend as far back as 2005. It's had 2 stock splits, one in 2010 and one in 2015. Looking at the financials, we can see that total revenue was up in 2018 going from 2017, slight decline in 2019, and a bigger decline in 2020 because of COVID-19. Now the question is, can Magna get back up and power through its earnings in the upcoming years? As Magna is expected to be a large playmaker in electric vehicle and autonomous vehicle technology, we should see those revenue figures go up. Even though revenues are down, we can see that Magna has grown its free cash flow from $1.5 billion in 2017 all the way to $2.1 billion. And that's why it's been able to pay a growing dividend along the way. I'm going to go ahead and add Magna to my portfolio. Now in this case, I'm going to go ahead and use my RRSP and buy 1 share of Magna. Place order. Done. The next stock I'm looking at is InterRent REIT. This is a Canadian real estate investment trust with close to 10,000 suites across Ontario and Quebec. The portfolio of assets is worth over $2 billion. Even though InterRent isn't a highly defensive business, people will always need a place to live. However, InterRent has also employed a growth strategy, which is why the stock has done so well over the years. InterRent's main strategy consists of buying older, undervalued assets in need of renovations. Once the company has invested in the upgrades and renovations, the shareholder value of these units skyrockets, which is why the company's stock has doubled over the last 5 years. And you can see that InterRent has a portfolio of apartments across Ontario and Quebec. And this is why I like investing in REITs, because essentially you get to pool your funds with other investors, and that pool of funds then goes out and buys quality assets. In this case, it's multi-residential properties, and the REIT will collect rent on your behalf and pay you a monthly distribution from that rent that's collected. You don't have to worry about managing a portfolio of real estate assets. You can just sit back and collect your monthly rent checks. And InterRent has seen tremendous growth over the years, going from $1.50 back in December of 2009 all the way to $15.64 just before the COVID crash. And today, it's currently sitting around $14 a share. It's paid cumulative distributions of $2.35 and a total return of over 1,000%. It's grown the number of apartment suites from 4,033 to close to 12,000 suites. That's 189% growth. Not only that, but it's also expanded recently outside of Ontario and Quebec into Vancouver, where it currently has 15 properties and 614 suites. And while Vancouver only makes up 5% of the portfolio, I'm sure that's going to grow over time. So there's plenty of reasons to see why InterRent will continue to grow over time, as it has done so in the past. And I'm sure their growth strategy will continue to push that stock even higher. And we can see that going back to 2017, it has continuously grown its holdings every year since 2017, where in 2021, it has added Vancouver to its portfolio. So it has a proven track record of strong acquisitions, which is exactly what you want to see as an investor investing in a company with a growing portfolio of assets. So that way you can collect a growing dividend. And you can see examples of units that they've upgraded where you can see the before and after pictures, which I think is pretty neat. Taking a closer look at its stock, it's currently trading just below $15 per share. It has a market cap of over $2 billion, a PE ratio of 12.86, and earnings per share at $1.15. It has a yield of just over 2%. And over the last 5 years, the stock has doubled, going from $7.40 to almost $15 today. And it still hasn't recovered from its COVID crash, so to me, it's still undervalued. So what do you get with InterRent? You get over 94% in a profit margin. The payout ratio is less than 30%, and currently is paying a monthly dividend of $2.07 per share. But this dividend has also grown over time. So if I scroll down, we can see that it has continuously paid a growing dividend since 2011, where it was just 1 cent per share. Looking at the financials, revenue has grown from over $109 million in 2017 to close to $160 million in 2020. And that profit margin has also grown from $76 million to over $114 million. And looking at the free cash flow, it has also grown along the way and had the dividends. To me, this is another strong position for my portfolio, so I'm going to go ahead and add this. We can see the performance over the last 5 years, last year, 1 month, and I'm going to go ahead and add 2 shares in my RRSP. So let's go ahead and buy, place order, done. The third stock I'm going to add to my portfolio is ACON. This is not a new position for me, so I'm actually going to add to an existing position. Why? Because ACON, I'm currently down 4%, and it's one of my small holdings at 3% of my portfolio. So adding to ACON right now, this allows me to average down on a position, so that way when the stock does move up higher, I can see profit that much sooner. And because it's only a 3% holding for me so far, by adding to it, I can grow this position. Another reason why I'm investing in ACON is that the business is doing well. They have over $40 billion in active bids, a $6.5 billion backlog. They have a 13% annualized 10-year dividend growth rate, a 23% growth in their 5-year earnings per share, and a 25% growth in the last 5 years in total return to shareholder. They have a diverse and resilient business model, working on projects from utilities, industrial, nuclear power, urban transportation systems, heavy civil, roads and highways, and they're working on projects across the country, all the way from the Quebec City Tramway to Calgary's Green Line LRT. And we can see that the project timeline going from 2021 extends all the way up until 2054. So they have plenty of work in the pipeline. This being a very long project over the next 30 years, the Gordie Howe Bridge connecting Windsor and Detroit. I'm going to go ahead and add more shares of ACON to my portfolio. And this time, it's going to be in my RRSP. So I'll go ahead and add 2 shares. Buy, place order, done. The next addition to my portfolio is not a stock, but an ETF. And this one is known as VGG, also known as a US Dividend Appreciation Index ETF. So why this ETF? Because it allows me to buy a basket of US dividend growth stocks without the hassle of foreign conversion fees. So this ETF holds a basket of US stocks that have a record of increasing dividends over time. And as I'm building a dividend growth portfolio, I can go ahead and buy dividend stocks myself. And then I can use this ETF to buy a basket of US stocks. So that way I can benefit from Canadian dividends and US dividends. This has an MER of 30 basis points. It has net assets of over $750 million and a yield of around 1.22%. It has over a 14% annualized return since inception. In the last 5 years, the growth has been 13% annualized. In the last 3 years, almost 12% annualized. And in the last year, it returned over 17%. Cumulatively, this ETF has grown over 170% since inception. So if you had invested in this ETF back in August of 2013 when it debuted, today you would have almost $30,000. So you would have almost tripled your investment. So within this ETF, you'll find over 200 companies with a return on equity at 23% and an earnings growth of over 11%. And with ETF, you get exposure to multiple sectors: consumer discretionary, industrials, healthcare, technology, consumer staples, and so on. Looking at the largest holdings, you get exposure to Microsoft, Walmart, Walt Disney, Johnson & Johnson, Visa, United Healthcare, Procter & Gamble, and so on and so on. So by adding this one ETF to my portfolio, I get a basket of over 200 US dividend growth stocks. So while I'll actively manage which stocks go into the Canadian side of my portfolio, I'll let Vanguard manage the US side. So time to add VGG to the portfolio. You can see the performance over the last 5 years, last year, 3 months, and it's at $63.50 today. So I'll go ahead and pick up 1 share in my RRSP. Place order, done. So now with these purchases, the total value of my portfolio is over $836, with $250 being in my RRSP and the rest being in my personal account. Here's a quick look at the spreadsheet before I add in my recent purchases. And now that I've updated the spreadsheet, I'll walk you guys through the changes. So first I'm going to go ahead and refresh the data. And so far today, I'm up $9.03 and have 29 shares in my portfolio. So today ECN's had a good day, up 6%. And ZIN, the Innovation Index ETF, is up almost 4% today. So looking at the dividend tracker, I'm expecting $2.03 to come through by the end of April. And I can see for each dividend payment what my expected yield on cost is. So for example, with TELUS, I'm expecting 31 cents, which gives me a yield of just under 5%. And when Allied Properties makes that payment on April 15th of 14 cents, that's a yield of 4%. So you can see my dividend snapshot right here. In March, I earned $1.11 in dividends. And so far in April, I'm expecting to earn 92 cents. Here's all my trade history. And if you have not signed up for WealthSimple, make sure you use the sign up link in the description below. So that way you can get a $10 sign up bonus on your first $100 trade. You can see my historical data right here. The loss that I had in February has turned into growth in March and April. So as of right now, I have a gain of $11.77, which is a return of 1.42%. I've changed the market value graph from a pie chart to this block chart so I can visually see exactly what is my largest holding. In this case, my largest holding is Magna at $112.16, and my two smallest holdings are Zin and TELUS at roughly $28 and $25. And then here's my waterfall graph, so you can visually see what's contributing to that $11.77 of growth. Bulk of that growth is coming from Bitcoin ETF, coming from ECN, and Magna, where I'm up $2.86, and I have small losses in these holdings. So going back to my summary, you can see that the largest gain I have at 15% is the Bitcoin ETF. The largest loss is the Innovation Index ETF. Magna makes up 13% of my portfolio, where TD makes up 10% of my portfolio. And I'm going to be using these indicators to determine what positions I add to next. So for example, right now I'm down in Allied Properties. I have losses in ATD and BAM, and another 1% loss in TELUS. So when I'm looking to average down, I'll be looking to these indicators to determine which holdings do I need to add on to next. And right now, TELUS is looking like a strong contender because it's only 3% of my overall portfolio, and I'm down 1.13%. So this will be something good for me to build on. So this is my portfolio in a nutshell. I've invested $830 so far, and I'm up just under $12. I have links to promo codes in the description below for various discounts and sign-up bonuses, so please make sure you take advantage of those offers, as they do help support the channel. If you have questions for me, feedback on this video, or maybe you have ideas on future content, make sure you let me know in the comments below. And while you're at it, make sure you hit that like and subscribe button. That's it for this video. I'll catch you guys in the next one.